Welcome to the Investing Show, where we discuss the news that matters to investors and invite leading experts to come in and tell us about ideas that can help you make more of your money. Joining me here in the studio, I've got Richard Hunter, Head of Equities at Hargreaves Lansdown.
Hi, Simon.
And Nick Batsford, CEO of TipTV.
Simon.
Coming up later on today's show, we've got Christine Johnson, Head of Fixed Income at Old Mutual Global Investors, who's going to come in and talk to us about how you can invest in the bond market safely, something that many investors are concerned about at the moment, with bonds being at very high prices. But first, a quick look at some things that have been happening since the last investing show, which you may have noticed involved a little bit of carnage on the markets, didn't it, Richard?
Yeah, the FTSE 100 as we speak is now down about 7.5% for the year. The heady days of the index being at around 7,000 seem a long time ago, although they weren't actually that long ago, something like 6 months. So it's a question of, rather than running for the tin hats and reading, or rather believing some of the apocalyptic headlines we're having, whether perhaps more slightly cautious investors may be looking at alternative ways of investing in these particular markets, and whether indeed the dips that we've been seeing has actually opened something of a buying opportunity.
Because, I mean, for those people who watched in astonishment on China's Black Monday when the market was tumbling down, I think at one point it was down 5.5%. If they'd have suddenly dived out then, they would have been down considerably more than they are now, wouldn't they? Well,
that's right. I mean, a loss isn't a loss until you realise it. You may be sitting on a paper position which is not quite so healthy as it was yesterday, but by the end of that week, the FTSE and the Dow Jones both finished up, despite what happened on the Monday, or that might not have been so widely reported. In fact, the previous week to that, so-called Black Monday, both of those markets have been rather weaker, down over 5%. So it's all a question of, and it's another good reason to kind of ride out some of these humps, so that, for example, although as a general rule shares start as medium risk, supposedly the only asset class of low or no risk is cash, and obviously that can be eaten away by inflation, although there's no inherent risk. But within the medium risk equities front, and obviously we're talking FTSE 100 for the purposes of the show, you look towards things that are called defensive stocks. So these are things that will carry on their business whatever might happen. So the obvious ones are the utilities, food, water, electricity, etc. And even the likes of Unilever, for example, whose portfolio of everyday household products is a wonder to behold. They've got several billion-dollar brands. They've had some troubles in some of the emerging markets, but as a long-term play, this is a company which for decades hasn't passed its dividend. It continues to be in most households in the developed world, and on that basis it makes it a kind of defensive play. So that's the first kind of approach you could take to investing in these markets. The second one is perhaps not so much unloved sectors, but clearly we know that interest rates, which will be coming on to historic lows at the moment. With that in mind, a lot of investors are currently chasing yield. So there might be a couple of sectors which are under pressure, where investors are effectively being paid to wait at the moment. In the oil sector, for example, we know that they've been under pressure because of the oil price. BP and Shell at the moment are both yielding, in terms of the dividend, 7%. And for example, in the pharmaceutical sector, you've got the likes of Glaxo and AstraZeneca yielding 6% and 4% respectively. So that's another potential approach you could take, which is effectively being paid to wait, whilst obviously making the most of high dividend yields, which becomes even more powerful if you reinvest those dividends for compound interest.
Well, I mean, I must admit that when you see the market so volatile like that, it's understandable why people get concerned. You can be told it's time in the market rather than timing the market as many times as you like. But when people see things like that, they think, whoa, and jump out. And as an anecdote, my sister actually emailed me. She had an email from her pension company, which, not the kind of email I would have sent out, but it was like, it basically was an email that said, all these funds, and this is down that, this is down that, this is down that. And she said to me, what should I do? Do you think I should move my money? Should I get out of them? And I said to her, look, you're not investing for the past 6 months. You're investing for the next 35 years. That's what you need to think about.
Absolutely right. And of course, the other headline that you don't see on the billboards is £80 billion added to share prices. It's rather less of a headline.
That doesn't sell newspapers, does it?
Unfortunately, it doesn't. So those are, in terms of general investment theory, those are a couple of things that you could be thinking about. The other thing is, well, we know that there's a lot of high quality companies within the FTSE 100. How about those which might have a bit less exposure to the Asian region, for example, but maybe a bit more exposure to the States, which obviously is in a reasonably good place at the moment, same as the UK economy. You need to look no further than having a look at some of the numbers, for example, of the likes of Wolseley, heating and plumbing, FTSE 100 constituent, and even WPP, which, although they do business in the Asian region, certainly are rather better known in the US as well. And ultimately, okay, well, let's put the tin hats on, go into the FTSE 100 and just look at companies which pretty much do their business in the UK. And even there's a few to choose from. There's the likes of the building merchant, Travis Perkins, which is obviously benefiting from what's happening in the housing market at the moment. There's the likes of Lloyds Bank, which, as we've seen, the government influence is becoming less and less by the day, which should be a positive, quite apart from the fact it's recently returned to paying a dividend. Slightly higher risk maybe, but William Morrison's a supermarket, pretty much UK focused, and even the likes of Whitbread, again, does some business abroad, but its twin towers of strength, being Premier Inn and Costa Coffee, continue to go to extremely strong levels of growth. So there are a number of different ways to cut the index and invest in the index, and by way of stepping back, of course, one of the reasons the FTSE has been under pressure is the way it's made up with such a high concentration, in particularly commodity and mining stocks, which has tended to drag the index down as a whole. But there remain a number of gilt-edged opportunities within the index.
The million-dollar question for me, Richard, is the volatility, do you think, set to continue, increase, reduce into Christmas with interest rates?
Well, that's the thing, isn't it? If you are taking a bottom-up investment approach, you will still see the headlines that the market, or the FTSE, is down another 3% today. And a lot of that will be because of the likes of the mining stocks, potentially the oil stocks, maybe even the banks, which have had a fairly rocky ride over the last 18 months. If you've taken a bottom-up approach, the chances are, on a broad brush basis, your stocks will have been marked down, but hopefully by not as much as those higher fallers.
You're beating the market.
You're outperforming the market for what it's worth. But again, you're taking a longer term view. In terms of the short term, who wants to guess the short term? The volatility in August was probably largely a factor of the light volumes. That's not to say it won't continue into September. At least we will know if it does continue into September, it's more realistic because everyone is effectively back at their screens.
Yes, yeah.
And also, of course, whatever's going to happen in September with the Fed decision one way or the other in a couple of weeks on interest rates, come the end of the month, we'll be looking forward to the third quarter earnings season on both sides of the pond. And if the second quarter was anything to go by, that could be a long overdue positive catalyst.
Understood.
That interest rates, you've got an interesting chart for us.
Yes, well, let's a few headlines. Newspaper review, read lots, but this I thought was a really, really good article. It was an investment extra in the Daily Mail. The author was Robin Geffen, a manager of the Global Alpha Funds. He basically said investors should ignore the lure of cheap companies as we head towards a rising interest rate environment. Last time we experienced this early in the 1990s, an environment of prolonged rising interest rates. Now, the slide I wanted to bring up, if we could, basically share of traders who began working on Wall Street, and absolutely aghast by this, almost a third of traders have only worked with rock bottom rates.
If they'd have started 3 years earlier, they'd have been all right.
Well, they would have been all right. But again, that suggests to me that people are not experts in this type of environments. But basically, we're talking about the turmoil in China in recent weeks will only delay the inevitable, i.e. we're about to have rate hikes, whether it's this year or next year. As a footnote, it was quite interesting. China's been down 40% since the summer, wiped off 1.6 trillion of shares, which is close to the value of the whole FTSE 100.
Wow.
which I thought was an extraordinary statistic. It wasn't in that, I read that somewhere else, but again, that's, you know, obviously concerning markets. So Robin goes on, believes America will hike rates up faster than the markets expect, while the UK goes slower than the markets expect. And his conclusion from that, the US dollar will strengthen. And again, we've seen a weakening British pound against the US dollar cable for the last 2 weeks. So maybe people are thinking about that. In terms of companies providing stock market leadership in this environment, he says that history shows quality companies tend to be the leaders. Believes that the bombed out oil companies may look cheap at the moment, but are likely to stay that way. So he's saying that he doesn't believe there's value there. Investors have not come to terms, he suggested, with structurally lower oil prices. In terms of his own portfolio, the household names they've got exposure in, as such as Nike, Starbucks and Walt Disney. And the important point at the end, he says, as always, basically talk to an authorised financial advisor before making investments. But I just thought the key to that, the number of people on Wall Street who have not been in an environment of rising interest rates, and rates are going up whether we like it or not. We're not quite sure when. He's saying stick to the world-class companies.
Hence the twitchiness, I guess. And the suggestion has now been that the Fed's going to might raise rates, but by a smaller amount that's been expected. That rather than the 0.25%, it might go for the 0.1%, just to get everyone used to this idea that they will have to go up. And it will be very interesting to see what happens. And
the other thing they say, of course, the other old adage is that financial memory is very short. And if it's only a third of this workforce, their last time interest rates were rather high, then you can imagine that that could have some sort of impact on sentiment if 30% of the traders there haven't experienced some of the things that might accompany an interest rate rise, which they've just never seen before.
Well, one of the places where fears of an interest rate rise are definitely wandering around is the bond market. And coming up after the break, we've got Christine Johnson, Head of Fixed Income at Old Mutual Global Investors, to tell us a bit about what's going on in the bond market and how investors can try and get their allocation to bonds, but do it safely. Join us then. Welcome back to the Investing Show. Now, it's unlikely that many people won't have noticed that there's been a bit of news in the bond market over the last few years. Bonds are expensive, but we're always told that we need to asset allocate. We need some bonds in our portfolios as well as shares. So the question that investors ask, and ask us regularly at This Is Money, is how do I do this safely if I'm being told that bonds are expensive? Now, joining us in the studio, we've got Christine Johnson, Head of Fixed Income at Old Mutual Global Investors, who's going to help us try and get to the bottom of that conundrum. Yeah. Christine, welcome to the show.
Thank you.
So tell us a little bit, what are the issues in the bond market? What's been going on?
Wow, where to start? Well, I know you talked a lot about equity, so let's just put things into context for a few minutes. I think what's been really noticeable in the last year even is if you look at the bond market compared to the equity market, you would think that the bond market, with fear of rising rates, would be where all the action had been. But actually, bond market has had something like between a half and a third of the volatility of equity markets. And if you start thinking about shorter dated bonds, they've got volatility maybe even half as much again. So actually, although the fear of rising rates should be being felt in the bond markets, it's actually been incredibly well behaved so far.
And why are those shorter dated bonds less volatile than a longer dated bond?
Some of it is just uncertainty. It's just the sooner you get your money back, the better. But some of it as well is if there is a rate rise, there is still the anticipation there'll be maybe one, tops two, they will be small, they will be slow to come along. So that means you've actually got quite a lot of certainty in that short end that you're not going to suddenly see, a rate rise and a rate rise and a rate rise. That would really unstabilise the short end. But instead it's very anchored because central bankers can't wait to tell you they're going to be raising rates very gradually, very contained pace.
I mean, the Bank of England, as an example in its inflation report, is a big fan of that chart that says, no, they're only going to go up very gently, they're not going to go above this point. And it's very much a similar story in the US, isn't it,
exactly,
where everybody's eyes are at the moment. But I think people still look at bonds and, prices on bonds for investors. Prices are high, yields are low, and they ask, so how can I do that safely? So as a bond investor, how do you approach a market like this?
We think of it as being risk reward. So if you think volatility equals risk, so in a way, if you have lower volatility, you won't get the high highs, but you won't get the real low lows either. So you're going to look around, first of all, to say, I don't want as much volatility, I don't want uncertainty, and instead I want where my best trade-off is going to be between reward and risk. And that always, for us, is putting us in that shorter part of the curve, and it's moving us down in terms of credit quality. So into things like corporate bonds and into the top end of the high yield market.
So those corporate bonds, they look more attractive to you than, say, government bonds at the moment. And the government bonds, they've obviously the price is there and the yields have been driven down by quantitative easing and very loose monetary policy. How would you say the companies stack up against that?
Well, if we go right back to the crisis, where did all the debt end up? In the end, you ended up with a world where governments ended up underwriting everything. And that meant all the debt ended up with the governments, and actually lots and lots of corporates are in much better shape than the governments of the countries that they're in. So you've got a world where actually, you know, global growth is okay. Interest rates are still very, very low. Inflation is still low. Profitability is at all-time highs. That's quite a nice scenario in terms of cheap funding, decent growth. That puts you in a pretty good place if you're a corporate.
Obviously, the risk with a bond is that the company goes bust, you don't get your money back, or the company doesn't make its payments. And that environment is good for those companies in terms of they're less likely to go bust, aren't they?
Exactly. If you can keep refinancing, if the cost of money is very, very cheap, you are much less likely to go bust. But a word of caution here, it is not just indiscriminate buying. The default rate is low, but the default rate is not zero, and it's slightly ticking up. So it's probably going to go up from about 2.7 to about 3 next year. Where they happen is down there in the CCC, the lowest rated. So when you're looking for that risk reward, you probably want to stay out of the real lowest reaches of the high yield market. You're okay being in your double Bs and your higher rated single Bs. We like bank bonds, for example. I'm really looking for things which are 4.5% to 5.5% yield, about 5-year maturity. That's the real sweet spot in terms of that risk reward trade-off.
What sort of companies are we talking about here?
You might be surprised, actually, in terms of some of the names. So, for example, in our portfolio at the moment, we have the likes of Thames Water, which pays 5.5%. Don't get much more boring than that. In Bondland, boring,
But we
regular.
like boring, don't we?
Boring is good.
Yeah.
But we also have the kind of consumer discretionary play. So if you've got low inflation, real incomes are starting to pick up, we like things like New Look, high street retailer, very big international and online presence. We like things like Centre Parks, because one of the geopolitical risks at the moment, or many of the geopolitical risks, people want to take their holidays at home maybe. And something like Centre Parks is a great way to say there's a bit more discretionary spending around. People are holidaying in the UK, so let's take advantage of that. And then we like bank bonds, as we've talked about, particularly lower down. And then looking further afield to the US, we like things like gaming companies and casinos. Again, it's the kind of consumer discretionary spend. You've got a few more dollars in your pocket. The oil price is very low. How about a lost weekend in Vegas? And that's the sorts of themes that we're looking to exploit.
Or a lost weekend in Centre Parks.
Is there still an almost guaranteed element of capital loss when you're buying high-yielding bonds? In other words, you're paying above 100, but they'll be redeemed at par.
Much less so, and particularly if you look at the European High Yield Index. Earlier this year, you're absolutely right, it was very, very hard to find decent bonds that were trading below their call price or below par. The market has weakened as actually this year's gone on. So now, if you're looking at European high yield, you've got about a 5% average yield, which is quite a nice entry point, and you're starting to be in a place where you can buy things somewhere just above par or just below par without taking an enormous amount of risk. So for us, that's quite a nice entry point at this point.
In terms of the strategies of the funds, are you looking to make some money on the bonds themselves, or are you looking to deliver that steady income? Which one of those two is paramount, or are you just looking to make sure people don't lose money?
More than anything, the less understood aspect of fixed income is the real way that you make money is you just hold bonds, you get paid your coupon, you let the magic of compound interest work for you. So there's an element of capital preservation. I don't really want the very long end. I don't want to be buying bonds that are a long way above par. But most of what you're doing is you're trying to buy a bond, get your money back, get paid your coupon, and be able to just reinvest that and reinvest that. It's nice that you can deliver a regular income. You have complete transparency and predictability in terms of cash flows. But really, the magic of that is trying to preserve capital and just getting paid your coupon and reinvesting it and reinvesting it.
So you would buy those short-dated bonds and hold them to maturity, would you?
Yeah, that would be ideal. Now, we do have this constant screening to say, is this now getting expensive? Can we cycle into something else? But really, you don't make money from buying and selling and turning over the portfolio a lot. It's better to buy things you like and then just sit there and get paid your coupon.
Because I think that's something that's actually, when we speak to our readers, has very much attracted some of them to the order of retail bond market, where they're buying those bonds individually. And what they've said is, I have no intention of selling this bond. that basically this company is offering me, 6%, 6.5% for the next 7 years.
Yep.
I'm going to buy that, and I'm not going to sell it. And there's been a lot of noise around, beware rising interest rates and things like that. But actually, I think a lot of these investors, they say, well, I don't want a bond fund manager trading in and out of the market. I just want to hold this to maturity. And so if you're looking at someone who is running more of a strategic bond fund or a sort of shorter dated bond fund portfolio, that's something that they are actually trying to do for you whilst spreading the risk, of course.
Absolutely, and I know a lot has been talked about problems of liquidity in the bond market. And one of the ways that shows up is your bid offer spread, your cost of buying and selling is expensive. So exactly, it means for us, do your homework, buy things you like, let compound interest do the work for you. I think the advantage clearly that we have is the fund is bigger, there's a greater diversification in terms of spreading the risk in the portfolio.
Yeah, I mean, it's very difficult and that's the one thing we've always said about stuff that's traded on the orb market is great, but it's very difficult for an individual investor to actually build up their portfolio of 10, 15, 20 bonds that they need to cover that risk, isn't it?
How many lines are you running at the moment in the TipTV fund?
We'll run somewhere between about 60 and 100, and we're currently about 80. It's not taking big bets on individual companies, it's about spreading that risk. And exactly so, we own bonds that we're very happy to own, but they trade in individual lot sizes of 200,000. For most retail investors, that's going to be outside their reach unless they really want to put all their eggs in one basket. So it does offer opportunities that perhaps aren't available to retail investors.
Yes. I should say to anyone watching, if someone does offer to sell you £200,000 worth of bonds, don't do that.
In terms of the default rate, why do you see that going up the curve?
It's ticking up next year, predominantly actually because of what is happening in the oil market. There is a big slug of companies who came probably at the wrong time. If you remember the whole shale oil revolution, there was going to be, amazingly, apparently there was going to be $100+ oil and a massive amount of oil supply coming on at the same time. Clearly this couldn't last. So you've now got companies where the music's starting to run out in the sense that they spent a lot of money on CapEx. They're not making actual cash at these oil prices, and their facilities will start to run out sometime in the next year. And unfortunately, that just means there's only one way forward, which is going to be restructuring.
Right. And have the banks got a lot of counterparty risk against these bonds?
I think one thing that's worked in the bank's favour post the crisis is the tightening of banking regulation has meant that they are much less exposed, and it's gone hand in hand with the growth of the high yield bond market, where normally these companies would have, you're absolutely right, completely financed themselves through the banking sector. They have looked to term out and to push their loans either into syndications or actually into the bond market. So this time the pain's being spread around.
Right.
It's not a bank story, everybody's sharing. Now, what it means for us in the European bond market, there's not much exposure there, we're not vulnerable to it, but it does mean we can look into the US market. We can actually look for the good that's been thrown out with the bad and start to say if we can pick and choose a few bargains.
And the reason for holding bonds, that is essentially, it's as a counterbalance to shares, isn't it, to equities.
Yep.
And I think that if anything has illustrated that is maybe the last couple of months where everybody was worried about the bond market being massively overpriced, it's the stock market that's taken a tumble. Presumably that would be the kind of example that you would offer up to people as to why they should invest in bonds, or at least some bonds.
And it is that the element of the unexpected. Everybody had a very, very consensus view at the start of this year. You wanted to own equities, you didn't want to own bonds. Well, just in case the world doesn't play out as you anticipate, it's always worth having something on the other side.
Brilliant. That's all we've got time for, I'm afraid. Christine, thank you very much for joining us. Richard, thanks very much.
Pleasure.
Moose, thanks very much.
Thank you.
Join us for the next show.